Hello and welcome everyone. I hope all of you are doing good. My name is Harshmeet Singh and I am here in front of you on behalf of Narayana IAS Academy. As you know, this is an endeavor in which we are helping you prepare your current affairs for this upcoming UPSC CSE prelims exam. As I am coming to you live today, there are exactly 40 days left, 40. Only 40 days left before the prelims examination is here. That is on the May 25th, 2025. And I really hope and wish that all of you are well prepared for it. Just in case you have any issues in preparation, this is usually with respect to current affairs and picking out the most important topics for revision. And this is why we are running this prelims crash course for you. In this crash course, our aim is to discuss the most important current affairs that have been in the news in the last year or so. This is your class for economics. We have already had 7 classes where we have discussed some of the most important topics along with practice questions on all of these topics. We'll be continuing once again and I really hope that you have been able to take advantage of this. If you have still not done that, do hit the subscribe button on this channel so that you can be updated about each and every video that is coming up here. Also, if you are one of those who is thinking that I'm not aiming for this prelims, my aim is next year or maybe beyond that, then the good news is that for you also, we do offer a couple of courses. We have 1 year and 2 year integrated courses which offer you in preparation for the entire cycle of the examination, from the prelims examination to the main stage of the examination and to the stage of the interview. This program also includes comprehensive answer writing practice, test series, making sure that you have the perfect timetable that is tailor-made for you. There are also weekly current affairs classes to help you get a grip on current affairs as well. If you need any other information about any of these courses, just check out the description of this video. You will find a link where you can get all this information about the courses that we offer you for your UPSC CSE examination. Now with that out of the way, and I hope all of you are ready, let's begin with the first topic that we have for you today. The first topic that we have for you is called as domestic systematically important banks or DSIBs. Now what exactly is this and why is it in the news? Now let's try and understand this. In any economy, banks play an extremely important role. For any economy to flourish, to prosper, every sector of the economy needs certain credits. Be it the farmers, be it the big industrialists, be it the MSME sector, all of them require credit or loans time to time in order to get their business running. On the other hand, people who have some money, people who have some savings with them, they also want to keep their savings safe and secure. For all this purpose, bank comes into the picture. Now, some banks become so big that they are the mainstay of the economy. Now, some banks, when they become extremely large, because lakhs of people, for example, have their accounts in them, they have offered thousands of crores of loans, they have owned multiple thousands of crores of government security. When the banks become too large, then the RBI would give them a new tag, and that new tag would be domestic systematically important banks. Means these are banks that are now too important for the economy to fail. Means these banks are so important, so critical that if something wrong happens to them, it will have a disastrous impact on the economy. So what RBI does, RBI gives a list of certain banks so that their administration, etc., can be taken care of. These can include private banks as well. It's not just the government banks. It's not just an India thing. World over, there is a phrase that you might have heard of. The phrase is too big to fail. There is a phrase called too big to fail. Now, what do you mean by too big to fail? So, there are certain companies that are considered as too big to fail, meaning that, let's say, there is a company in a nation that employs lakhs of people. If something wrong happens to that company, if it shuts down, if it faces a humongous loss, the entire economy will be impacted because so many people will be out of the jobs, the government will lose out on huge tax revenue, the government will have a lot more burden on them. Because of this, the governments make sure that these companies do not fail, no matter what, if something wrong is happening in them. If they need certain support, the government will come and help them out because these are too big to fail. Similarly, when this happens with the banks, when banks become too big to fail, this is where the banks are categorized as D-SIBs. The reason why it is in the news is that RBI releases a list of such banks in India. There is a global list also that is released that globally which banks are too big to fail or which banks are systematically important. And you should know, the last big recession that the world saw was in 2008. And that recession started in the US with certain banks actually going down. The famous story of Lehman Brothers, Goldman Sachs, because these banks were too humongous, they had huge amounts of deposit, they had given out huge amounts of loans, because when they crumbled, the entire world's economy had to go into shatters. This is where the RBI also realizes this, and they have regarded certain banks as too big to fail in India. Now, when this list was released recently, the RBI said that these banks would include State Bank of India, HDFC and ICICI. So there are three banks that are included here. Just to put things into context here so that you understand. If you rank banks of India in terms of their market cap, means the valuation of that bank as a company, you see how much valuation a company has. Just talk about the HDFC. Do you know the valuation of HDFC or the market cap of HDFC is almost the same as all the government banks combined. Let that sink in. HDFC alone, a private sector bank, it alone has market cap which is almost the same as all the public sector, all the government banks combined. Gone are the days when you thought State Bank of India is the largest bank of India. No, the private banks have taken over them. HDFC in itself is a humongous bank and has a huge market capitalization. Now, if you put things into perspective, as I told you, the D-SIBs concept is a concept where the RBI says that certain banks are too big, too important for the economy and we cannot allow them to fail. These are categorized as D-SIBs. This concept started after the 2008 recession. As I said, the 2008 recession that had its roots in the US housing market crisis. When the housing market crashed, it led to a lot of banks crashing down in the US, a lot of the banks going bankrupt. That had an impact on the financial systems across the entire world, including in India. In 2008 recession, many people lost their jobs. This is where this global idea came in, that let's have certain banks, categorize them as too big to fail so that these banks can be taken care of. So the Financial Stability Board, that is the FSB, they came up with this idea called as the Global Systematically Important Banks in 2011. So it was first an idea that came up at the global stage, that globally there are some banks that are too important for the world economy and they should not fail. Meaning that if something wrong starts to happen here, we should pay attention to that as soon as possible without waiting for the things to become bad here. On those lines, the RBI then took up the idea, and RBI also releases this list. But as I said earlier, it started at the global level. Now, how does RBI decide which banks would be in the category of too big to fail, or which banks would be in the category of so-called as D-SIB bank? This is important for you. So RBI takes into consideration multiple parameters to decide whether a bank would be under this list or not. First, bank with a size exceeding 2% of the national GDP are assessed. So this is the cutoff. If a bank has a size, that is the market cap, which is over 2% of the national GDP, only those banks will be considered. However, that does not mean that all the banks that have market cap of over 2% of our GDP will automatically become systematically important. No. This is just the initial cutoff. It's similar to like saying that in the CSAT exam, you have to score 1/3. But that doesn't mean that if you score 1/3 in CSAT, you automatically qualify. No, that is just the cutoff. You have to fulfill that and then your paper 1 or your GS paper 1 will be considered. Similarly, the first criteria is this. After that, banks are evaluated on many factors. For example, how much connections do they have with other financial institutions, how interconnected they are, how much loans have they given, how much loans have they taken. Then, how complex the institutions are they irreplaceable, what kind of services do they provide, are the services that they provide so important that they are irreplaceable, they cannot be provided by any other bank, any other institution. All this is taken into consideration, and on basis of that, the RBI finally takes a call whether to include them in such a list or not. Now, apart from that, the banks usually get a score. They are assigned a score on the basis of many factors, and then they are placed into certain buckets. So, even amongst those banks that have been given the status that you are systematically important, even amongst those, there are different categories of banks. So, they are put in different buckets, bucket 1, bucket 2, 3, 4. This is how it was, and I'll show you those buckets as well. So, as I said, bucket 1 is that bank which is at the lowest risk because of its working, because of how much money it has. So, in banks, how do you categorize whether they are at a low risk or a high risk? There are various ways in which you can define whether a bank is low risk or high risk. For example, if lot of the loan that the bank has given out, a lot of that is only to one or two parties. It does happen in some cases. Let's say the bank has a huge client, a real estate company or a big corporate house. Out of all the loans that the bank gives out, most of it is with one company only. That is not a good sign. That means the bank is at risk. Why? Because if that one company goes bust, they will not be able to return the money and the bank has a big problem. Similarly, apart from that, how much reserves does the bank have? How much money does the bank keep it with itself? All that is taken into consideration to decide whether the bank is at low risk or high risk. So, if a bank is placed in bucket 1, it represents the lowest risk. The bank in bucket 4 represents a higher risk bank. Now, amongst those, if you look at how the banks have been placed, SBI, that is the State Bank of India, is in bucket number 4, so it is higher risk. HDFC is in bucket number 3 and ICICI is in bucket number 1. So, these are the different buckets that we have. There is no bank amongst these that is in bucket number 2. There is a bucket number 2, but there is no bank like that for now. So, again, this fact can also be asked. Bucket 1 represents the banks at the lowest risk profile, means there is the least probability of them going bad, and the bucket 4 is the higher risk one, means these are the banks that may see something wrong happening. Apart from that, as I said, how do you define whether a bank is safe or whether the bank is at risk? There is a criteria. For example, look into the tier 1 capital of the bank. Now, what is tier 1 capital? Tier 1 capital is the core capital that the bank has, that the bank can use at any point of time. So, the money that you have with the bank, the profit that the banks have, the interest that the banks charge from people, all that is the income that they have. Amongst that, a part of it is categorized as tier 1. Tier 1 is the most important because this is the earning of the bank. This money bank can use without being answerable to anyone. It is their own money. So, how much tier 1 capital do they have decides whether they are safe or they are at risk. It is the primary financial buffer. If they have some losses, let's say the banks make a loss, they have a high NPA, if something like that happens, tier 1 capital that they have is the most important one to absorb all those losses. Now, you all might have read about Basel III. I really hope in your preparation you might have read about Basel III. Basel I, Basel II, Basel III. These are the norms for the banks world over. These are rules or principles are there how to keep their capital safe, how to keep their working safe. So, they are told how much money do they have to keep with themselves, how much loan should they give out, etc. So, as per Basel III standard, there are two types of tier 1 capital. One, that is common equity tier 1, it is the highest quality of capital, means that the bank can use it immediately without asking anyone. It includes the common shares of the bank, the retained earning of the bank, undisclosed disclosed reserves that the bank has. So, this is the highest quality of capital because this can be used by the bank whenever they want. Then there is something called additional tier 1 capital. This comprises of perpetual instruments like non-cumulative preferential shares, etc., certain other bonds that the bank has. So, going into more detail, first tier 1 capital is the one that is the most easily available to the bank. This is the one that helps the bank absorb any short-term losses or immediate losses. Then if you go deeper, as per Basel III norms, tier 1 capital is also of two types. The one that is the common equity capital, this is the one which is the most important for the banks. If they have enough of this, they will be assured and they won't have to see a risk in the near future. As per Basel III norms, this is how much money the bank should have. As per Basel III norms, the first kind, that is the common equity capital that they have, they should have at least 4.5% of risk-weighted asset. Now, what do you mean by risk-weighted asset? It's slightly technical, let's try and understand that. So, what is the risk that the bank has? The risk that the bank has is the loan that they have given, okay? Now, different loans come with a different risk. For example, if you give a loan to the corporates, let's say you have given 100 crore loan to a corporate because they are setting up a new plant or they are setting up a new factory, they have taken 100 crore loan from the bank. This is categorized as 100% risky. So, RBI decides how risky would it be. Then let's say you have given 2 crore education loan. Education loan, for example, is considered 50% risky because there are half chances of it coming back, half chances of it not coming back. Let's say you have given 1 crore home loan, and let's say RBI says this is 0% risky. So now how much capital is at risk? How much of the loans that you have given is at risk? You have to calculate that. So out of this 100 crore, it's 100% risky. So 100 crore is at risk. From the second loan, out of 2 crore, it is at 50% risk. So you have to add 1 crore more, that is at risk. Third loan, 1 crore you have given, but this is not risky at all, so you don't add anything. So total risk-weighted asset that you have is 101 crore. That is how you calculate how risky is it that your loans will come back or not. Of this amount, you should have at least 4.5% with you in the form of your own earning, in the form of your own money that you have. So this is the common equity capital. So common equity capital as per Basel III norm should be at least 4.5% of these assets. Similarly, the minimum tier 1 capital should be 6% of this asset. This is slightly more technical. If you want, you can skip this part to remember this, but these are the Basel III norms. Basel norms have been asked by UPSC in the past. Basel III is the latest version. The banks in India have to abide by Basel III by 2025, that is by this year. Their deadline is this year, so RBI wants them all to abide by this. Basel I and Basel II norms had come in earlier. This is the bucket that we were talking about. When RBI categorizes banks into D-SIBs, that is, they are too big to fail, then they put them into these kind of buckets. There are 5 buckets in total. The bucket number 1 is the one that means you are at the lowest risk. That means if you are in this bucket, there is a very little chance that something will go wrong. Then bucket 2, bucket 3, bucket 4, these are the banks which are 3 only that RBI has categorized. They have put them into this bucket. Do remember this. Now, as per Basel III norms, we just discussed, as per Basel III norms, there is certain amount of capital that the banks should keep with themselves, right? Depending upon how much loans have they given and depending upon how risky the loans are. Now, RBI has played it even more safe. RBI says that I am not satisfied with this. RBI says that apart from the percentage of amount that you would have to keep, because Basel III norms tell you, you have to keep some additional money with you as well. So, for example, if the Basel norms tell the bank that you should keep 1000 crore with you because how much of loan you have given, RBI says that you should keep even more than this. How much more? RBI says if you are a bucket 1 bank, you should keep 0.2% more. If you are a bucket 2 bank, you should keep 0.4% more, then 0.6%, 0.8% and 1% more depending upon which bucket you are in. So now again understand, the RBI categorizes certain banks as too big to fail, okay? These are important because if something wrong happens to them, it will have an impact on the economy. For these, the Basel III norms tell that depending upon how much loans have you given out, depending upon the kind of loans that you've given out, depending on how risky the loans are, you should keep certain amount of capital with you. That should be in the form of tier 1 capital. Tier 1 capital is the capital that you can use immediately. But RBI says, I want to play it even safer. RBI says, apart from the Basel III requirements, you should keep some additional money with you. That will depend upon which bucket you are in. If you are in bucket number 1, that means you are at the safest position. So just keep 0.2% more. If you are in bucket 2, then keep 0.4% more. If you are in bucket 3, 0.6%, bucket 4, 0.8%. If you are bucket 5, then keep 1% more with you. Then you will be safer. Why? Because the RBI says we cannot take a chance with these banks. If something wrong happens with these banks, that will have a disastrous impact on the economy. So all of these have to periodically give a report, and all of them have to fulfill these conditions. Now, as I said earlier, this is not an India-based concept. In fact, on the other hand, the RBI took this idea based on what was happening globally after the 2008 recession, when the world economists realized that there are certain banks that are too important for not just US but the world economy. This is when they came out with globally systematically important banks. This concept originated with Financial Stability Board, that is the FSB, along with the Basel Committee. They are the ones who came up with this idea that we should identify certain banks globally that are too big to fail. Now, as of 2023, we have that latest data only. 29 banks were considered too big to fail globally. There was no Indian bank here, but the banks that were too big to fail globally, for example, included JP Morgan Chase, Bank of America, the Citigroup, HSBC, Agriculture Bank of China, Barclays, BNP Paribas. These are some of these that have been included in this list. And again, the idea is that if something wrong, if there is only even a smallest of sign that something wrong is happening in these banks, the authorities must step in immediately. Because if you look at the 2008 recession, that was because of the housing market crisis in the US, all the signs were very clear. Everyone knew that something wrong is about to happen, but no one intervened. This is why we have a situation where the world now wants not to wait any further. If something wrong happens, if there is even the smallest of sign that something wrong is happening in these banks, there should be an immediate intervention in such cases. On that note, let's see if you are able to answer a few questions here. Read it carefully. From top to the bottom, read each and every statement carefully. See if you are able to answer this, and then we can discuss. Got it? Okay. With reference to domestic systematically important banks or DSIBs in India, consider the following statements. Number 1. DSIBs are banks whose failure could cause significant disruption to the Indian financial system and economy, earning them the label too big to fail. Yes, we discussed this specifically. These are the banks that are too big to fail. If something wrong happens in them, they can be a major disastrous impact on the entire economy. So there should be regulations put in place to avoid their failure. The Reserve Bank of India identifies the DSIBs annually based on indicators like the size, interconnectedness, substitutionality or substitutability, and complexity. Yes, that is also correct. We discussed how do they take this into consideration. They look at a lot of factors, many indicators, how connected they are to other banks or to other financial institutions, how connected they are, how much loans have they given, can they be substituted or not, or if there is something else that holds them or that makes them special. Third, all banks with assets exceeding 1% of India's GDP are automatically classified as DSIB. No. There are a lot of things wrong with this statement. First, it is 2%, but that also does not make you automatically qualified. The banks who exceed over 2% of India's GDP are the banks that are considered. They are not automatically classified as DSIBs. It is ultimately the RBI's decision. They will be the one who will take a lot of other factors into consideration, like you see the second statement. So first cutoff is their size should be at least 2% of India's GDP. Then this comes in that whether they are integrated or not, how big size they are, what is the complexity of their operation, how much loans have they given. When that is satisfactory for the RBI, then they decide whether they are DSIB or not. So third is wrong. 1 and 2 are correct. The answer will be A. Not a difficult one. Should be able to answer this. If you want to take a screenshot of the explanation, feel free to do that for later revision's sake. Moving on to the next question, let's see if we can answer that one. Read it carefully, think what the answer should be. Done? Okay. Which of the following is a key regulatory requirement imposed on domestic systematically important banks in India? First, maintaining a fixed deposit rate lower than non-DSIB banks to reduce risk exposure. No, nothing like that. It doesn't have any impact. Second, holding additional common equity tier 1 capital based on this systematic importance bucket. Yes, remember we discussed this. As per RBI, the DSIB banks are put into 5 different buckets, 1, 2, 3, 4 and 5, depending upon how exposed they are to risk. If they are exposed to the lowest amount of risk, they are in bucket 1, then bucket 2, bucket 3, that is how it works. If you are a bucket 1 bank, you have to maintain additional tier 1 capital of 0.2%, then bucket 2 for 0.4, bucket 3 0.6, 0.8 and then 1% for bucket number 5. So, B is the correct answer here as per the RBI regulations. Got it? If you want, you can take a screenshot here for your revision's sake of how these buckets work. Moving on then, I have a related previous year question for you. Not exactly, but slightly related to the topic that we have. Let's see if you can answer this. Read it carefully. This was a question asked in 2018. Read it carefully. Think about what the answer should be. Alright. Consider the following statements. Number 1. Capital adequacy ratio is the amount that the banks have to maintain in the form of their own funds to offset any loss that the banks incur if the account holders fail to repay dues. This is what we have been discussing. We discussed this in the last question as well. Depending upon how much loan that you have given and the risk profile of those loans, as I told you, not every loan is 100% risky. Depending upon how the loan is categorized, so RBI, for example, will decide which loan is considered 100% risky, which is 10% risky, which is 0% risky. So, depending upon that, you have to maintain certain amount of funds with yourself so that in case you face any losses in the future, that can be offset. CAR is decided by each individual bank. No. If banks themselves will decide, then what will be the purpose of it? The entire idea is to regulate the working of the bank, tell them or kind of force them that this is the amount of money you should keep handy with you, something wrong happens. So, banks alone will not decide that. That is wrong. A is correct answer here. 1 only is correct. The second statement here is wrong. Not a difficult question to answer. It was asked in 2018 prelims. You should be able to answer this one. If you want, you can take a screenshot here. Okay. Perfect. Then let's move on to the next topic. Next, we have a very unique, interesting topic that you usually do not see often in the news. There is something called perpetual bonds. Now, let's look at these two words separately now. What is perpetual and what is bonds? Let us first talk about bonds. Bonds is an easy way for a company or a government to loan money from the market. So, let's say the government of India wants to take some money from the market because they want to build certain infrastructure and they don't have money. So, the government will go to the people and they will ask the people, please give me money. So, for example, government will say, let's say if you give me 1 crore rupees, I promise you that I will give you 10% rate of interest and after 5 years, I will give you your money back. So, what happens is government will give you a certificate in which all the details will be written that I have received 1 crore from you, I will offer you 1 crore, I'll offer you 5% or I'll offer you 10% rate of interest, after 5 years I'll pay the money back. That's called a bond. So, in a bond when you invest, you get your principal back, principal amount, and you get your interest back after a few years. It's mainly an investment instrument. Now, let's look at the second word. The second word here is perpetual. Perpetual means something that has no end date. Let's say if you are, I don't mean you, let's say someone is suffering from a disease that has no end, you can just keep on having medicine and the medicine will just keep the situation under control. So you would have to have this medicine perpetually. There is no end date to this. Now combine these two and you get a very interesting concept of perpetual bonds. Means some companies, some organizations may offer you a perpetual bond. Means they will ask you, give me, let's say 10 lakh rupees, I will give you 5% rate of interest or 10% interest till the end of life. It will go on, there will be no end to it. But you will not get your principal amount back. That is the condition. So if you gave me 10 lakh rupees, forget that 10 lakh. Now, some rate of interest on that 10 lakh, let's say 5%, 10%, 2%, whatever rate of interest we decide, I will keep on giving you that rate of interest back or that interest back till the end of life. This is called perpetual bond. When you invest in a certain instrument, you don't get your capital, you don't get your principal amount back, but you keep earning your interest back year after year without any end to it. This is called as the perpetual bond. Now, why is it in the news? Because it has been going on for hundreds of years. Because as I said, perpetual means there is no end. And when there is no end, then what is 100 years and what is 200 years and what is 500 years? So the reason why it is in the news is a Dutch water authority. So in Netherlands, a water authority, they issued perpetual bonds because they needed money in 1624, 401 years ago. And they are still giving out interest to the family of the people who had given them the money then. So it's not that because a person has died, so they will stop giving the interest. These are perpetual. So whoever is the next person in the family hereditary, whoever passes on, they will keep on getting that. So they have an annual interest that is paid to them. These are perpetual bonds that will keep on continuing. So 400 years have passed and this authority is still giving out this. Now this is not something that just used to happen earlier, doesn't happen now. It happens now as well. There are certain institutions which are ready to give you perpetual bond. Now obviously, when someone offers you perpetual bond, the rate of interest will be much lower. You can't expect a 5% or 10% rate of interest, because again, that will put them into a lot of losses. So there will be a much lower rate of interest, but the safety or the security that you have is it's perpetual. It will just keep coming back in the form of an interest every single year, but you have to forget about your principal amount that you had given. These are also called console bonds. Do remember this? These are called as console bonds with no maturity date. Maturity date again is the date at which usually in usual bonds, when the government, for example, or the corporate house takes money from you, they tell you that come back after 5 years, come back after 2 years or 10 years and take your money back. That is a maturity date, that your bond will mature after these many years on this date. But because this is a perpetual bond, there is no maturity date. There is no date on which you can come and say, oh, now give me the entire money back. No. They provide investors interest payment indefinitely. They trace their origin to 18th century when the British issued them, or British government issued something called the console bonds. But again, console bonds name came up by the British government, but the Dutch have been running this since 1624. So perpetual bonds, console bond, depending on whatever you want to name them, the purpose is the same. That someone who wants to raise money and is ready to give an interest till the end of time for perpetuity. For that, you also have to then trust the organization, right? When you think or you assume that the interest will be given back over a very long period of time, we also have to trust that the company or the organization will exist for that longer period, right? If the organization doesn't even exist, then what is the point of having these bonds? So usually, when you see these bonds being issued, in most cases, these are issued by government authorities. Because for government authorities, you can be rest assured that the government will exist in some form or the other. The private houses, the corporates, you don't know whether they have a future or not, or how long a future do they have. With the governments, you're better assured or you're more assured. So you will see that these kind of things are usually issued by government authorities when they're taken by the people. This is how it works. Financial institution or the government will take this bond or will give this bond. It is again, they receive regular coupon payment. Coupon payment basically means interest payments. So they will get regular interest payments, and again there is no maturity date, so there is no principal amount coming back to you. The interest rate obviously will be lower as compared to usual bond, because that's the general idea. If I am offering you that you give me some money and I will keep on paying interest on it till the end of life or till the end of time, I would obviously not be willing to offer you a very high interest rate. That defeats the entire purpose of it. Because I don't want this amount to be repaid in 10 years, 15 years. I want it to be stretched much longer. This is where the perpetual bonds come into picture. Again, usually these are not the kind of things that you will see in India. That's why you will not usually see this in the news. But these have been used earlier. Means if you go back 2 centuries, 3 centuries ago, that is when these were usually used, when they used to be offered mainly by the government entities or government authorities. And again, the idea is that government authorities are most trustworthy in this scenario. Because as an individual, why would I buy a bond of an organization about which I don't even know would it even exist after 10 years, 15 years or so. Now, why do the banks issue them? As I told you, the good part or how it works for the banks or why it works for the organizations is that it provides them a capital. We just discussed in the last topic when we were discussing about systematically important banks, how important is it for the banks to have some capital with them? How important is it that they should have some money with them so that if a bad situation comes in, if they have certain NPAs, if the money is not coming back, then they should have the capital to absorb those losses. This kind of a capital thus helps the bank in providing or in having that kind of a capital. It is categorized into tier 1 capital. We discussed in the last topic, tier 1 is the purest and the highest quality of capital that the banks have. Now, also there is one more technicality that you need to understand here. When a capital is termed as additional tier 1 capital or additional tier 1 bonds, that also has a significance to it. What significance? Let's assume there is a company that has taken loans from some people, that has taken money in the exchange of equity, means some people are shareholders in the company. What if that company goes bust? What if that company goes bankrupt? If a company goes bankrupt and they have a lot of loan debt outstanding, the first thing that usually happens, the assets of the company are sold. So the company might have certain property, the company might have certain intellectual property rights, the company might have certain assets, all those are sold. Now when the company sells all these assets and they will get some money, the first problem that now occurs is who will first get the money? Will the banks first get the money? Will the shareholders first get the money? Who will first get the money when the company is liquidated? This is how the banks have an upper hand. So when there is a liquidation, means the company has liquidated, they are into losses and they have sold out their asset. The banks repay the perpetual bond after settling other debts but before paying the equity investors. So if there is a liquidation and you had bought perpetual bonds in that, first right to get the money is of the banks who had given loans to the company. Then comes the right of the perpetual bond owners. So people who had bought perpetual bonds of that organization, they will be the one who will then get the money. And then in the end will come the equity holders. Now the interest rate, depending upon which organization is issuing these kind of bonds, can vary. It can also vary depending on the profitability of the bank that has issued this. We are assuming that banks are the ones that are issuing these bonds right now. So depending on the profitability of the bank, it may increase, it may decrease depending upon how the bank is performing financially. If they are performing better, they have more cash in their hand, they might offer a better rate of interest. If they are performing not as per the expectation, the rate of interest might decrease. So in most of the cases, they do not have a fixed rate of interest that is offered in exchange of these perpetual bonds. This will make it easier for you to understand for revision purposes. First, infinite coupon payments. Again, understand coupon in the form of interest. So the money that you have given and you are earning interest in against that, call that coupon payment. So every single year you will get some money in your account, that will be coupon payment or the interest payment. No yield to maturity means there is no maturity date. It will not be like on this date after these many years you can come and we'll give you the principal amount back. No, the principal amount is not to be given back. That is how they are perpetual bonds. Then there's an embedded call option. Now, what do you mean by embedded call option? So, some options or some banks, while offering these kind of bonds, they decide with the customer that if in the future there may be a situation where you are in a need of money and you would want your principal amount back. Now, please understand, usually in these bonds, principal amount is not given back. But if the banks at the time of giving the bond might have this conversation with the customer that there may be a time when you would want your principal amount back, then let's have a deal that on this date, on predetermined dates, you might get an option to then buy it back. Why the bank does it? Because the banks would also want a situation where their annual burden reduces. Because see, when you offer perpetual bonds, that means that's a liability on you till the end of time and you cannot stop it. So the banks also might want to stop it. So the banks do decide with the customer that okay, there will be an option that okay, on these decided dates, if you want, you can take it back, but there will be no fixed maturity date as such. Also, there will be no return of principal. As I said, principal will not be given back, but you can end the bond with certain conditions. If the banks and the customer agree to certain conditions, they might together decide that okay, we'll end the bond now, but automatically there is no date on which it will mature. What about taxation? What about taxes? Are they supposed to give taxes? Yes. So they will be giving taxes on the basis of your total income anyway. So let's say you have a job and you earn a certain amount of money which puts you in 30% tax category. So if you're in 30% tax category from the other sources, just add this interest income to your income and that is the amount that you will pay. So there's no special different income slab for them. It will depend upon your common income slab depending on how you earn your salary. Also, if you exercise this option to sell the bond in the secondary market. So there is something called secondary market, there is something called primary market. Let's say bank is selling the bond. You buy directly from the bank, this is called a primary bond or primary market. When you are selling that bond to someone else, you are not the issuer of the bond, but you are then selling it ahead, that is called the secondary market. So if you are selling, you are not the issuer of the bond, but you are saying that's called the secondary market. So these bonds can be sold in the secondary market. You can sell it to someone else. You can tell the person, give me a lump sum amount because I need it right now. You now take the bond and you will be the one who will receive the interest now in perpetuity. So it will work for you. In this kind of a situation, when you sell it, there will be long-term capital gain tax if you held the bond for at least 1 year imposed on you. Remember, in one of the earlier classes, we did discuss about long-term capital gain. I really hope that you have watched it. The long-term capital gain, short-term capital gain, we discussed both these concepts. How if you hold a certain asset up till a certain point of time and after that you sell, the profit that you make on that amount, a long-term capital gain is imposed. On the other hand, if you sell that asset before a certain time period, short-term capital gain tax will be imposed. Just reminding you, short-term capital gain is usually kept higher because the government wants to encourage you to keep the asset with you longer. Also, if you make some losses, you can offset that against your profit for up to 8 financial years. We discussed all of that. Just in case you have not watched the earlier classes in this series, do watch those as well. You'll find these videos in the playlist. All of these are extremely, extremely important for you. These are certain benefits of these kind of bonds. It gives you a steady flow of income. Also, it gives you a protection against inflation because as the prices of the commodities are increasing, you will get an interest, a steady interest depending upon whatever your conditions are with the bond. So you would not have to invest money time and time again. Then there are also a very good way of portfolio diversification. Portfolio diversification, as you know, is when you have certain money and you are investing in certain areas, it's good not to put all the eggs into one single basket. So you invest some money in the stock market, some money, let's say, in FD, some money in the form of gold or silver or other kind of instruments. Similarly, investing some money over here would also ensure diversification. So if something wrong happens with one kind of an instrument or in one kind of industry, at least your money will be safeguarded in the other industry. On the other hand, there are certain risks as well. First, interest rate might fluctuate. Interest rate in cases like these depend on the performance of the bank that have issued these bonds. There is a credit risk as well because again, What if the organization that has issued the bond all goes bankrupt or doesn't exist anymore? Because when you're taking something for perpetuity, you assume it will go on. But what if the organization itself doesn't exist? So there's always that kind of a risk, and there's lack of principal repayment. The principal will not be given back to you. So the money that you have given will come back to you, but it's kind of a trickling down. So it will trickle down in small quantity. If you're fine with that, then these bonds will work for you. I hope you understood this topic. Let's see if you have. Try and answer this question. Read this carefully. Think about the answer. Maybe you can pause on this screen if you wish to, and then you can play again. All right. With reference to perpetual bond in India, consider the following. Number one, perpetual bonds are debt instruments with no maturity dates, offering interest payments indefinitely unless redeemed by the issuer. Absolutely correct. We discussed exactly this. These are bonds that will run for perpetuity, mean there is no end date, there is no maturity date, they will just keep on giving in interest year after year after year. Second, in India, additional tier 1 perpetual bonds are issued by banks to meet Basel III capital adequacy requirements. Yes, we discussed this. We discussed in the first topic of the day what are Basel III norms. Why is it that they give 4.5% as a capital adequacy ratio? This is the amount of money they should have or the bank should have. That is calculated on the basis of the loans that they have given, the risk profile of that loans, that is how it is decided. So when banks issue this kind of a bond, the money that they get, that is categorized into additional tier 1 capital that helps them absorb all the financial shocks that they might have in the future. The SEBI banned the issuance of perpetual bonds in 2024 due to their high risk to retail investors. No, quite the opposite. SEBI in fact has tried to make it easier to get the banks to issue these kind of bonds. So it's a very interesting kind of a thing where banks are issuing the bonds. So banks are under RBI, bonds and these kind of security instruments that are issued, these are looked into by SEBI. So there are both of these regulators that look into it. This is wrong. In fact, SEBI has been trying to improve the ease of issuing these bonds by the banks and improve the ease of people buying these bonds. It works for both. The customers get a diversified kind of a option to invest their money. Banks also get additional capital. So it works for both. Third is wrong. 1 and 2 are correct. A would be the answer here. Okay, I hope you got this one right. A is the answer here. If you want, you can take a screenshot here. As I said, in 2024 July, SEBI allowed mutual funds to value AT1 bonds as well on a better scale so that they can make it even more attractive for the banks to issue these bonds rather than banning it altogether. You can, if you want, you can take a screenshot for revising later. Moving on, the second one. Let's see if you can answer this one. Read it carefully. Slightly tricky. Let's see if you can answer this. Which of the following best describes a key feature of perpetual bonds issued as additional tier 1 instruments by banks in India? So it's again about these kind of bonds. First, they carry a fixed maturity period of 10 years. Now we just discussed there is no maturity period. That is why the name perpetual bonds has come in. Second, they can be written off or converted to equity if the bank's capital falls below a certain threshold as per RBI norm. This is correct. We did not discuss this, but this is correct. Why? So the banks also again have to ensure that they have certain amount of capital with them in order to be safe. RBI has given them this option that the bonds that you have issued, you can convert them into equity. Means you can tell the people that, okay, we won't be giving it back to you, we won't be giving the interest back to you, rather let's convert that into equity. Means in return, we will give you certain shares of the bank. So you will hold a certain ownership or you will hold certain shares of the bank. So we are converting it into equity. RBI has allowed that so that the banks are not dissuaded from issuing these bonds. The banks can also freely issue these kind of bonds. B is the correct answer in this case. If you want, you can take a screenshot of this explanation as well. You can revise it later on. Now I have a previous year question for you on a topic that is similar to the one that we have discussed. This was asked in 2021 prelims exam. So just a few years back. Let's see if you can answer this particular question. Read it, it's slightly tricky. Think about what the answer should be and then you can play. All right. The Indian government bond yields are influenced by which of the following? So bond yields, consider that as a rate of interest. That is, when you give some money to the government in the form of a government bond, how much interest are you getting in return? That is the bond yield. Now consider this. First, action of the US Federal Reserve. So US Central Bank is the US Federal Reserve. What they decide does have a major impact here. We discussed this in one of the earlier classes as well. If the US Federal Reserve, for example, increases the rate of interest means it becomes more attractive for investors to invest their money in the US itself. US anyways is considered as a very safe investment bet by the investors, just that it does not offer a good rate of interest. But when the rate of interest is increased by the US Federal Reserve, investors around the world, including the foreign investors in India, would want to take their money out of India and invest in the US. Now, how does that impact our Indian bond yield? Because when the investors are going out, we would want to improve or increase our rate of interest also to attract them back. So if the US Federal Reserve, in short, increases its interest rate, makes it more lucrative for others to invest in the US, we would also have to do the same. We would also have to increase our bond yield to bring them back. So it does have an impact. Second, actions of RBI. Again, absolutely yes. RBI decides how much liquidity will we have in the market. RBI decides if they want to buy government bonds or not. As you know, RBI undertakes something called open market operations, OMO, under which they buy and sell government securities to decide how much money will there be in the market. So if there is no government security available in the market, the rate of interest might increase, and vice versa, it can bring down as well. Inflation, short-term interest rate, again, yes, when you have a lower interest rate in other instruments, people obviously would want to buy more government security. And when a lot of people are ready to buy government security, its interest rate again will come down because there is a lot of demand. So all of these have an impact on government bond yield. All of them have an impact on how much rate of interest will the government bonds carry. The answer thus would be D. 1, 2 and 3, all of these will have an impact on the bond yield of the Indian government. All these are absolutely correct. If you want, you can take a screenshot here as well. Got it? All right then. Moving on to the next topic. Next topic is called Project Nexus. We are still in the banking world right now, and the next few news stories, again the current affairs, will be from banking. First one is Project Nexus. Now why is it in the news? Because the RBI is the latest bank to join the global Project Nexus initiative. Now what exactly is this initiative? See, as the world is becoming more and more globalized, someone sitting in India is buying something from Singapore, you're buying something from US or vice versa. There is a lot of transaction happening between different countries. Someone sitting in India might want to buy something from some company in America, you want to transfer that money. Now, there is a system of money transfer from one country to the other country that happens right now. That is called the SWIFT system. So, SWIFT system does allow transfer of money from one bank to the other bank in different countries. But the SWIFT transaction or the SWIFT system is usually for large value transactions from bank to bank. It's a system that does take slightly longer. It has been ongoing for a long time. It is still the most widely used system of transfer of payment between banks of different countries, banks of different regions. However, now the Project Nexus is trying to replicate that or trying to actually find a better way. So what will it do? Project Nexus is aiming to have a real-time transfer of money just like a UPI. You know, when you pay a merchant or when you pay someone through UPI, there is an instant transfer of money. This is what makes UPI so special. See, when you're working in the financial market, when you're working in the money market, trust is the most important commodity. Imagine a situation where you are at a shop, you are paying someone through UPI, the money has been deducted from your account, but it has not reached their account. There is an awkward situation. You can't leave them. They won't allow you to leave because the money has not been given to their account. Money has been deducted from your account. So even if there is slight lag between the two, it creates a very awkward situation of a lack of trust. In financial institutions, trust is the most important commodity. If the payment transfer is instant, like what happens in UPI, this is what makes it special. This is what has given it the kind of success that we have all seen. This is what banks are now trying to do at the global stage as well. This is what Project Nexus is about. Who is leading this? Who has started this? So the Project Nexus is led by Bank for International Settlement called BIS. They have an international arm called Innovation Fund. They are the ones who are trying to do this. So the idea is there should be cross-border retail payment by integrating domestic instant payment services globally. So please understand, this is not a bank-to-bank transfer. Project Nexus is mainly about retail payments. So if you are buying something just in a retail manner from someone in China, US, Singapore, Australia, then the money transfer that you are giving to them should be instant, and there should be options available to do that without the banks having to do it, the banks having to use the infrastructure. That is the idea. So the SWIFT system is separate. SWIFT system, as we discussed, is mostly for big value transactions from bank to banks. This system, the Project Nexus, mainly focuses on retail transactions, real-time retail transactions without the banks having to come in and use their heavy infrastructure in between. So this system is not trying to replace SWIFT. SWIFT will have a separate modus operandi, they will have a separate use case, it has a separate use case. The idea is to standardize the way that these payment systems work and connect with each other, to build custom connections for all the countries that want to work together. It will again be real-time instant. That will be the USP of it, because in any financial system, any financial transaction, the best way to gain trust is when you have instant settlement of payment. Also, it will make it easier for the new countries to come on board, because again the idea is these kind of things will only work when you have a lot of participating countries or a lot more merchants coming on board. The more merchant, the more countries that come on board, the more countries that assimilate their network with one another, the easier it becomes. Because for example, if I as a consumer am told that, see, use this one app, using this you can pay to merchants anywhere in the world, that is something that I would like. But I won't like an option where you will give me an app and say, from this you can pay to someone in Australia and Singapore and Hong Kong only, not in other places. Because the acceptability or ease of these kind of instruments will only be when it is accepted by as many major economies as possible. For that, you have to make it scalable and interoperable. That is what this idea is about, Project Nexus. These kind of questions are very often used, asked by the UPSC. And they can ask this in various ways. They can say Project Nexus recently in the news is related to what? Or they can ask Project Nexus recently in the news is an initiative of which organization? So a lot of these can be asked very easily by the UPSC. So do pay attention here. Now, as of 2024, there are certain countries that are working together to come on board. Which are these countries? Central Bank of India, it is the RBI, Central Bank of Malaysia, Philippines, Singapore, Thailand. All of them are working together for its live implementation. There are some countries, some regions that have already come on board. For example, Malaysia, Singapore, Eurosystem, so European countries, a lot of them have already come on board. So it's already something that is in the final stages. India is also happy to come on board. India anyways, as you know, has been at the forefront of expanding the use of UPI as much as possible. We already have multiple countries where UPI is accepted. In certain places, it is also accepted in France, Singapore, Sri Lanka, Nepal, Bhutan. So in many countries where UPI is already accepted, we anyways are in favor of expanding or the ease of payment transfer. Now, the one organization that is behind this all project, an extremely important organization that forms the backbone of the entire international banking system is BIS, that is Bank for International Settlement. Bank for International Settlement. You know, when you think about it, when we think about globalization, global trade, all of that, we think a lot about organizations such as UN or WTO. Now, WTO has made the trade easier. They have had globalization, they have had their own principles and rules that have come in the picture. But we don't realize the fact that trade is only possible when there is a seamless system of transfer of payment. If you don't have seamless system of transfer of payment available, no country will be able to trade with each other. This is where the BIS, that is the Bank for International Settlement, plays such a crucial role, such a key role, but unfortunately it has not been given the kind of name or the kind of popularity that it should. So BIS is the world's oldest international financial institution, even older than the UN. Came into being in 1930. Right now there are multiple central banks that together operate and that together run the operation of BIS. Founding members were mainly European countries and the US. They were the ones who first wanted to work together, who first wanted to make it easier for the payments to be transferred. So the founding members were Germany, Belgium, Italy, France, UK, Japan, Switzerland and US. Japan always been an exception. Being an Asian country, it's always model itself on the growth path of the European countries. Headquarters is in Basel, Switzerland. Basel again is the place famous for Basel I, Basel II, Basel III norms. It acts as a bank for international monetary cooperation, for ensuring financial stability. Right now, it is not owned by any one single country or entity. Right now, it is governed by 63 central banks together. RBI also became a part of it pretty late, that is in 2013. Almost all major countries around the world, country of any repute, country of any significance is a member of BIS. So much so that right now the countries that are a part of BIS make up over 95% of the world's GDP. So safe to say that all the major countries, all the major economies at least, are a part of the BIS, Bank for International Settlement. Individuals and central bank, both of them can have the shares of this. Voting rights, etc., are only given to central banks. So central banks of the respective country, like RBI for example, will vote on India's behalf. Similarly, other countries will have their own central banks that will vote on their behalf. What does it do? If a central bank of a nation has to take a loan, they would also have to go somewhere. So it lends loan to central banks of other countries. It also helps them with research and statistics, etc. It also gives certain kind of suggestions to central banks that this is how your economy can be improved, this is how you can bring payment, or this is how you can make it easier to transfer payments, etc. All of that is the job of the BIS, Bank for International Settlement. Do remember this information, extremely crucial for your examination, because these kind of questions are very regularly asked. On that note, let's see if we can answer a few questions based on Project Nexus that we discussed. Read this carefully, think about what the answer should be, and then we'll discuss. Alright, with reference to Project Nexus, consider the following statements. Number one, Project Nexus is an initiative by Bank for International Settlements to enable instant cross-border retail payments by linking domestic instant payment systems. Absolutely correct. This is a perfect definition of what exactly Project Nexus is, as we discussed. The idea is the retail transactions. If you are buying something from a merchant in some other country, you should be able to make an instant transaction to them without a lot of hassle, without having the need to go to the bank. This is where Project Nexus comes in. Second, India joined Project Nexus in 2024, integrating its UPI with the payment system of ASEAN countries. Yes, we have reached a lot of ASEAN countries. If you are buying something there, you can scan the QR code like you do in India. Similarly, you can pay to them and the money will be instantly showed and highlighted into their account. So that has been a big win for India. The primary objective of Project Nexus is to replace a SWIFT system for all international financial transactions. No, as I discussed, SWIFT is a much bigger system. The SWIFT transactions are mostly between banks and banks. These are much more bigger value transactions. These are not retail transactions. What we are talking about in Project Nexus is retail transaction. Think about this as saying, let's say you are a tourist, you go to Singapore. You buy something from Singapore or you eat someplace at Singapore. Now in India, it's very easy now. You can just scan the QR code and pay them through UPI. In Singapore, on the other hand, either you have to carry cash or you have to, let's say, carry the card, which would have certain transaction charges. Rather than that, what if you can again use that UPI kind of a system, just scan a QR code and transfer the money instantly. That is what this Project Nexus is about. The retail payments between two countries should be made easier. The idea is not to replace SWIFT. SWIFT is an interbanking transaction system. It's much wider scale, much larger. That is not something that will be replaced by Project Nexus. 1 and 2 are correct. Answer will be A. Third statement is wrong because it is not replacing the SWIFT system in any capacity. I hope you got this right. If you want, you can take a screenshot from here. If you want to revise later on, it will be helpful for you. One more question. Let's see if you can get the second one right. Read this carefully. Not a difficult one to answer. Think about it. All right. Which of the following best describes a key feature of Project Nexus, an international payment initiative involving India? First, it mandates the use of central bank digital currencies for all cross-border transactions. No, that is not a part of this. Second, it facilitates instant cross-border retail payments by interlinking domestic fast payment system like UPI. Yes, exactly what we are talking about. This is what Project Nexus is. Just like India has UPI, other countries might have their own kind of system based on IMPS, based on instant settlement of transactions. To link that, to make sure that all the countries can offer this retail transactions real time. This is what Project Nexus is. Correct answer is B. Pretty simple to answer this one. If you want, you can take a screenshot here as well. Now I have a related previous year question for you. See if you can answer this. It was a question asked in 2019. See if you can answer this question. The chairman of public sector banks is selected by Banks Board Bureau, Reserve Bank of India, Union Ministry of Finance, or management of the concerned bank. Now this has been a major contention. That is, how much control does the government hold of the public sector banks, or how much independence or freedom does the government give it to these banks and allow their management to take the decisions? That has always been a major cause of discussion and debate. The government, it has been seen, wants to control as many public sector banks because they want to control their lending activities, they want to control how their operations are. For that, a new initiative was taken. The government said that, okay, we will not interfere. Let us have a new organization called the Banks Board Bureau, BBB. This is something of a individual or independent authority. They will be the one who will look into high level appointments of the public sector banks. So not the RBI, not the Union Ministry for Finance, it is the Banks Board Bureau set up in 2016. They will be the one who will look into appointment of higher positions in public sector banks. What higher positions? Such as a chairman, managing director, CEO of all these banks will be appointed or will be selected by the Banks Board Bureau. Do remember this part. Pretty straightforward question. If you know this, you know this. Otherwise, you can't really make a guess in these kind of questions here. The next topic that we have, again something that was in the news, is the M-Bridge project. Now what exactly is M-Bridge project? Why is it in the news? Let's try and understand that. Now to understand this M-Bridge project, understand the idea that the central banks around the world are now trying to introduce their own version of digital currency. Now, in India also, RBI, for example, has started this as an experiment, that RBI has rolled out its own version of digital currency. Many other countries are doing it. Now, in order for that to be successful, again, it is linked to the fact that it has to be accepted across the borders globally, because that is how international trade will use this version of national currency. So, this is what M-Bridge is about. It basically addresses challenges in international systems or payments. It is again led by BIS that we just discussed. Please understand the difference. The project Nexus that we discussed was mainly about transactions between one customer and a retail partner between different countries. So, someone in India can transfer money into the merchant account in Singapore. On the other hand, M-Bridge is mostly about ensuring that the central bank's digital currency is accepted around the entire world. That is the entire idea. Now, please understand the concept here. Cryptocurrency and digital currencies are not the same. A lot of people get confused here. Digital currency is just that, for example, let's say in case of India, in case of RBI, digital currency is just a digital form of Indian rupee. It is not cryptocurrency. Cryptocurrency is something separate. Cryptocurrency, number one, has no backing of the government or of the central bank. It has no inherent value. The value of the cryptocurrency depends upon the buyer and the seller. They decide what one Bitcoin or one Ethereum will be equal to. There is no set value of that. Also, there is no central controlling authority who is deciding how much is available, how much will be published, how much will not be published. On the other hand, the central bank digital currency is a way for the banks to try and make sure that we remove the need for physical currency, we remove the need for these physical barriers or the physical infrastructure to be put in place. That will be a digital form of the Indian rupee itself. A lot of currencies around the world are now adopting this. The M-Bridge project is about making sure that the banks around the world are accepting each other's digital currency as well. Now, for this also, as long as this project has participation from multiple banks, only then it will be successful. So, banks from China, Thailand, UAE and Hong Kong, these four are the ones that have started this project in collaboration with BIS. Do remember this, the founding members or the founding central banks that are working towards this project, that is the M-Bridge project, are these four: China, Thailand, UAE and Hong Kong. These are the ones that are coming together to launch this. The single aim of this is to make sure that the high cost, delays, limited financial inclusivity of payment transfer from one place to the other place between the countries is eased off. So, this might lead to improvement in SWIFT. The project Nexus that we discussed, that is not related to SWIFT. That is not about bank-to-bank transfer. This is the one that is focusing much more on bank-to-bank transfer. It is trying to integrate and improve the problems in SWIFT, because SWIFT does take a lot more time in payment settlement. Also, apart from this, this entire idea of central bank digital currency, as it is called, these currencies are built on distributed ledger technology. Now, I am sure in science and tech, all of you would have read about cryptocurrency and how they are based on a technology called the blockchain. Now, what is blockchain technology? Blockchain technology is built on distributed ledger. What is distributed ledger? Let's try and understand. The best part about Bitcoin, for example, or cryptocurrency is that anywhere in the world, if one person sells a Bitcoin to someone else, there is a ledger, means there is an account, there is a account book of Bitcoins where the record will automatically get updated. You can see, anyone can see transactions that are happening in Bitcoin. They can't see the identity, but they can see, for example, one Bitcoin was sold today on this date on this time. This is a distributed ledger where it is automatically updated, number one. And secondly, no one can intervene here, no one can interfere here, no one can change those transactions. So, that is beyond anyone's scope of interference, number one. It does not require any human being to come in between, and it adds a lot of authenticity because it gets updated real time. that is called distributed ledger. Means the ledgers or the book where the accounts are kept are distributed. There are multiple copies available around the world. You can also check it out, and this gets updated real time. In fact, this kind of a technology, a blockchain technology, or distributed ledger technology, is something that the countries are working on to allow online voting in case of elections as well. For example, in our elections, we have been discussing for a long time, why can we not allow people to vote online? And the biggest problem here is, what if one person votes twice or thrice? To avoid that from happening, we can use this kind of technology where the records get updated real time without anyone's interference. This is also the basis of most of the central currencies around the world. Now, right now, as I said, it has been started by a few countries and their central banks together. China, Thailand, UAE, Hong Kong, Saudi Arabia joined later on. India, as of now, is not a part of this. So please have this in mind. India right now is not a part of this. Again, for Project Nexus that we discussed earlier, the last topic, India is a part of it. India is happy to assimilate UPI with as many countries as possible. But in Embrace project, India is not a part of it. One other reason why India is not a part of it is it's a project that is being run by China mainly. Why? Understand the consequences here, understand the psyche of China. China in the past few years has been trying very hard to make its currency the global currency. You know, China has so much trade around the world. They want that their currency should be acceptable as a global currency, and they have been successful in doing that. The Chinese yuan, for example, now is a currency that is a part of the IMF basket of currencies, which is a big jump. When you are a part of this IMF basket of currency, that means that you are a currency that is globally well accepted. Because everyone around the world has to buy something from China, the countries also are ready to take the Chinese currency. Imagine this. If we are buying oil from Saudi Arabia, which currency would Saudi Arabia like to have from us? If we pay them in Indian dollars, they will not be happy, because what will they do with Indian dollars? They will only be able to accept the currency which they can use in other parts of the world. Like, because US dollar is accepted everywhere, that's why they ask us to pay in US dollar. Similarly, if the country thinks that, oh, Chinese currency is fine because I have to anyway buy so much from China, Chinese currency has become a global currency now in the past few years. This is an initiative by China to improve the ease or improve the access of Chinese currency even further. So the Embrace project seems from India's point of view as a way to get the Chinese currency accepted even more far and wide, something that we do not appreciate. China is doing this because, as I said, it helps China in internationalizing its currency. They have been in talks with many countries around the world to get their currency accepted. For example, I'll give you an example here. Many decades back, Saudi Arabia and the US signed a deal. The Saudi-US deal many years back was called the petrodollar agreement. The petrodollar agreement was something like the US promising Saudi Arabia that whenever you need any weapons, our best of weapons will be available to you. In return, they asked Saudi Arabia that you promise us one thing. Whoever you sell the oil to, make it a condition that you will only accept payment in US dollars. As long as you accept payment in US dollars only, we would be happy to exchange those dollars, and we will be happy to buy or sell you weapons or whatever technology that you would want. That was called a petrodollar agreement. Because Saudi Arabia for the longest time was the largest exporter of crude oil, that they sold crude oil to all the countries around the world, all of them had to pay them in dollars, so demand for dollar automatically increased. Simple argument. Something same is now being done by China. China is increasingly coming close to countries such as Iran. With Iran, for example, China a few years back signed a $400 billion deal to have a lot more investment in Iran. Similarly, they have signed a deal with Saudi Arabia as well. So that is one way to go ahead, because China is again learning from history. They are learning from what the US had done, that the US had used their proximity with the countries in West Asia or the Middle East, as you call it. They use proximity with those countries to increase or shore up the demand for US dollar, because those countries will only accept payment in dollar. Exactly the same is being done by China now. China now wants to kind of push these countries forward to say that we will only accept payment in Chinese currency now, the Chinese yuan, so that China's currency, the demand for Chinese currency shows up in the international market. With Russia also, China now buys a lot of stuff. As India's oil buying from Russia has increased, China's oil buying has increased even further. So China has had this deal with Russia also that our bilateral trade should be in yuan only. So Chinese yuan has been now accepted in many parts of the world, and this is where they are pushing this project forward, the M-Bridge project, under which if people want to deal in Chinese currency and they don't have it in physical form available, they can do that in the form of CBDC, that is the central bank digital currency. So it's not just India, China is also trying to ensure that their currency gets as widely distributed as possible. Please do not confuse central bank digital currencies with cryptocurrency. Those are very different things. This is just the digital form of our own currency, of our own rupee. Cryptocurrencies are not regulated by any authority. The government or the RBI, no other authority has any control over what the value of cryptocurrency will be. One Bitcoin will be equal to what? No one can decide. Tomorrow, if you have a 500 rupee note, you go to the market, no one is accepting that. What do? You can go to RBI. The bank note that you have itself says, I promise to pay the bearer of this note value of rupees 500. So if your note is not acceptable in the country, you can always go to RBI that has given you this promise. But on the other hand, if you own a Bitcoin, you want to sell it, somehow you are not getting any buyers right now. Or if you want to buy a Bitcoin and you're not getting any buyers around the market, you can't go to government or RBI. These are not regulated. Their value may crash down, their value may soar. There is no dependence on the government or on any regulator. So cryptocurrencies are very, very, very different. In fact, cryptocurrencies cannot be traced as well. That is also a big problem. Increasingly, a lot of cyber attacks that are taking place in the world, cyber attacks on US, cyber attacks in Russia, China, India also, when many of these cyber groups hack into a system, they are now demanding payment in cryptocurrency. We saw that in the US also, just a few years back. There was this big, huge American oil pipeline company that was hacked by hackers. Their accounts were frozen and they demanded payment in the form of Bitcoins. Only when you pay them in Bitcoin would they release or would they go out of a network. That is easier for them because they know Bitcoins cannot be traced. If you transfer money in the bank account, you would know in which bank account are they asking for payment. So you would know who exactly are these people, because the bank would have done the KYC while opening the account. This is where cryptocurrency has become a major problem. Please understand that is not the same as digital currency. These hold the same value as fiat currency. Fiat currency basically means the currency notes that you have. So the 500 rupee note, 100 rupee note that you have, all these currency notes that you have are called as fiat currency. So they hold the same value as fiat currency. They are not like cryptocurrency. They are secure, convenient alternative to physical cash. So you can use them for digital payment. You can use them for physical, you can use them in place of physical cash. That is how they work. They are not the same as cryptocurrency. Don't be confused with that. RBI has already launched its version of the digital currency. We have seen that being rolled out. RBI has launched two versions of it, or they plan to use it in two ways. One, CBDC retail. CBDC stands for Central Bank Digital Currency. Central Bank Digital Currency. So they have launched two uses of it, or two applications of it. First, Central Bank Digital Currency Retail, that will be for general public use for your transaction purposes. And then there will be Central Bank Digital Currency Wholesale for interbank and institutional transactions, so that the banks can now deal with each other. Banks can now communicate with each other, or the banks can transfer money using this currency only. Globally also, many countries have done this. It's not just India that has launched its own digital currency. For example, countries such as Bahamas, Nigeria, East Caribbean Currency Union, they have already launched their own version of the CBDC. Similarly, China, Sweden, Ukraine, Jamaica are also doing this. You know, one other very interesting application of it, I'll give you an example. If you are being confused that is it not the same as UPI? It's not the same as UPI. I'll give you an interesting example. Let's say the government of India has this scheme under which they are giving 1,000 rupees to a family. You know, the idea of universal basic income, for example. Universal basic income, the idea is that the government should give a certain amount of money to everyone in the country for their most basic needs to be fulfilled. So basic needs such as food, etc. should be fulfilled, so that even if they have zero money, the government is at least giving them something. The people who speak against it are of the view that the problem with government giving universal basic income is, let's say government transferred 1,000 rupees to a person. How can the government make sure that the person not misusing that 1,000 rupee? What if from that 1,000 rupee person is using that to make a dream on Dream 11 these days, or the person is using that to buy alcohol, or the person is misusing it or wasting it? How can the government make sure that that 1,000 rupees is being used for food only or for the children education only? This is where this kind of a system can come in. So if the government, for example, says that you are using digital currency, since it is controlled by the central bank can also program this in such a manner that this currency will only be acceptable at these places. Like if they transfer this, let's say, digital currency to your account, you cannot use it, you will not be able to use it, let's say, at alcohol shops. You will only be able to use it, they will only be accepted it at education institution. It will only be accepted at restaurants and nowhere else. This is one other application of how it can be helpful for the government as well. They can restrict the use of it, they can restrict the application of it, so that whatever is the aim or the goal of this currency or this money transfer is, that goal is then fulfilled. France, Singapore, Switzerland have also launched their trials. They are also making sure that they are also ready to go with it. So multiple countries around the world are now trying to see if they can have their own version of digital currencies. If you understood this topic, let's try and see if you can answer this question. Read it carefully. See if you can answer this. All right. With reference to M-Bridge project, consider the following statements. Number one, the M-Bridge project is a multi-central bank digital currency platform aimed at facilitating real-time cross-border payments using a blockchain-based ledger. Exactly what we discussed. It's a perfect definition of this project. So that the countries around the world, banks around the world especially, are open to transfer of money without using the SWIFT system. It will be done real time. It will be used in digital currency. So the chances of something going wrong are reduced. Second, India became a full participant of M-Bridge project in 2024. We just discussed, no, we are not a part of this. Whenever a project is led, spearheaded by China, India already has certain apprehensions towards it. This is one of those things. China is the one leading it. They are the one making sure that their currency gets accepted around the world. We have our apprehension, so we have not joined it so far. The project is exclusively managed by BRICS countries to reduce dependence on the US dollar for international trade. No. There are a lot of talks about it. BRICS may be planning to have its own currency to ditch the US dollar. Ever since America put sanctions on Russia, there have been talks about how can it depend on US dollar only. But nothing like that has happened so far. From India's point of view, de-dollarization is not a great thing, because with America we anyways have a trade surplus, so we do get more dollars from them. So for us, de-dollarization would not really make sense anyway. One is the only statement that is correct, second and third are wrong. A would be the answer here. The answer is A. I hope you got this one right. If you want, you can take a screenshot from here as well, just to revise later on. All right, let's see if you can solve the second one. Read this carefully, see if you can answer this question. Which of the following best describes a primary objective of M-Bridge project, an initiative involving multiple central banks? Number one, to establish a single digital currency for all participating countries replacing the national currencies. No, that is not the idea. Every country will have their own digital currency. It will just be accepted around the world. That is the idea. It will not replace other countries' currency. To enhance the efficiency and reduce the cost of cross-border payment using central bank digital currency. Yes, that is the idea. To make sure that the cross-border payments are much easier, there is no transaction fee or there is no late transactions that are involved, so that it can be real time. B is the correct answer here. I hope you got this one right as well. If you want, you can take a screenshot from here. I have one more question, that is a previous year question related to this. Let's see if you can answer this. It's a question asked in 2020. Think about this. Got it? With reference to blockchain technology, consider the following statements. Number one, it is a public ledger that everyone can inspect, but which no single user controls. Absolutely correct. That is what makes the cryptocurrency, etc., not cryptocurrency, but their technology very useful for countries around the world. That's why the countries around the world are contemplating whether we can have other applications of it, like in elections, etc., because this is something which is publicly visible, but you cannot interfere with it. It will only be done automatically. Second, structure and design of blockchain is such that all the data are in it about cryptocurrency only. No. Cryptocurrency is just one application of blockchain technology. Blockchain technology, as I said, can be used for many other things. It is being used for many other things now, securing the government data, the data that the government has, making sure that the government transactions are not prone to any interference. This is not something, or cryptocurrency is not something which is the only application. It is one of the many applications that the blockchain technology has. Third, applications that depend on basic features of blockchain can be developed without anybody's permission. Yes, many startups in fact are doing this. Many startups are developing many applications on the basis of Bitcoin, basis of blockchain technology. They don't need to take permission from anyone, because blockchain technology is not owned or controlled by any authority or any entity. This is just a technology that is available in the public domain. So many startups, for example, a lot of these bitcoins, or not the Bitcoin, but many of these cryptocurrencies, Ethereum or Dogecoin, etc., these are just ideas of certain startups. So they have built apps on it without anyone's permission. The apps, for example, that allow you to sell or buy cryptocurrencies, all of these are based on this blockchain technology. So they don't need to take anyone's permission, and they can still work on it. They can still make this idea or use this idea. Answer thus would be 1 and 3D. I hope you got this one right as well. Not a difficult question to answer. 1 and 3 would be the correct answers here. If you want, you can take a screenshot from here to revise later on. All right then, with this, we come to the end of today's session. I really hope that you learned something new today, and we have been helpful in making sure that your preparation as you move towards the preliminary examination is stronger than ever. We have many more classes to go. Make sure you join us tomorrow at 12 once again, where we will take up the remaining topics for economics. Every single day, Monday to Saturday, we have these classes, so that before the preliminary examination arrives, you are able to conquer and revise all the current affairs of the last year or so. Once again, my name is Harshmeet Singh, and I was here on behalf of Narayana IAS Academy. Thank you so much. Bye-bye. Jai Hind.